Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty, and this is a one-year daily candle chart of the Russell 2000 Index, ticker symbol RUT. And if you are new to the weekly market report, understand that each and every week I leave my lines on the chart from the previous week's report so you can see how accurate the candles were with regard to forecasting the market action. And as I zoom in here, you'll see that right here was Friday the 24th, which was when I recorded the last weekly market report, and I said that we would most likely break out of the high back here from April 14th and move higher. The end of the line, when I draw a diagonal line like that, the end of the line is my target price. So you can see not only did we break out over that resistance high, but we continued up, actually hitting my target on Tuesday. Wednesday we went a little bit higher. Thursday we pulled back. Friday, as I record this, we gapped down and we pulled right back to the breakout point from Monday. Now, normally I would say there's a good chance that the market will bounce because this is technically known as a roll reversal. It's when former resistance back here is broken, that line reverses its roll and turns into support. But what I think is going to happen is I think we're going to drop a little bit more because the oscillators down here, you see the stochastics crossing, that's a sell signal. And the CCI is still showing downward momentum. So I think we're going to continue lower on Monday. So let me erase all the lines. We hit the targets there, and I will redraw the line as I see the technical signals rolling out for us here. So like I said, I think we will pull back to the 20-period moving average, and there's a slight gap right here. See that? So I think we're going to move lower, fill that gap, and then we could possibly move higher to fill this gap on the upside. But the telltale sign of an actual pivot point for me is going to come in the form of the CCI down here. So I think the CCI will drop a little bit more and then possibly hinge higher. So we'll have to see how that pans out. But that's the Russell 2000. It's a small cap index. Covers 2,000 stocks. And as I move to the diamonds, you'll see this is the Dow Jones Industrial Average ETF, ticker symbol DIA. It tracks 30 Dow industrial stocks. And just like the Russell 2000, I drew my line on Friday right here. I projected that we would move higher. Look at that. On Wednesday, we hit that target price exactly and then pulled right back from it. So again, the technical charts did a great job with forecasting the market. And just like the Russell 2000, let me erase these lines, you could see that the stochastics is just about to cross with a sell signal. So I think that will move lower just like that, bringing the diamonds down to a very small gap opening right down there. And I think at that point we might see a bounce, but it's still too early to tell. I do believe that that gap will fill. Keep an eye on that. And if it drops below this gap fill support level, then I would say keep your stops in place, refrain from buying any new positions, and protect against the downside because we have a gap opening down here which could very well fill. I don't think that's going to do it next week, but it will act as a price magnet eventually, so you have to keep an eye on that. This is a great market for traders, swing traders especially. Option traders are having a field day because the added volatility is giving all of our option traders a higher return on investment because volatility premium is pumped into the options that they're selling, and that turns into be more cash in their accounts. So let's take a look at the Qs. That's ticker symbol QQQ. It represents the tech sector. The markets did move up. Like I said, we did break out over the high back here from the 17th. However, we did not quite hit that target. We just missed it by a hair and then pulled back. There is a gap opening up here which will act as resistance, so we have to keep an eye on that. And there's a gap below the market down here. So right now we're more or less caught between the gaps. I think just like the other markets, the Russell 2000 and the diamonds, I think we're going to pull back we could possibly hit this as a support level down here and then possibly bounce from there. So we'll have to see. You'll see down here the stochastics is crossing with a sell signal, and the CCI has crossed with a sell signal on Thursday, and it's about to cross below the momentum line. Now, interesting thing here for the Qs, and this is why I'm less bullish, or I should say more bearish on the tech sector, is that the stochastics here shows a lower high after we just set a higher high in price. That's known as a negative divergence. And when the oscillators do that, you have to keep a very close eye on that, because same thing down here, the CCI is showing a negative divergence, and we saw that same exact thing happen back here right before the big crash. You see this negative divergence? We had a higher high back here in February, but we had a much lower high on the CCI. So that's why we really are putting the caution flag out for any new positions. Make sure you're using the 1% rule for managing risk and protect your downside. Now, I'm going to hop to the VIX. That's the volatility index, ticker symbol VIX. This is a leading indicator that I keep on my watch list. It is inversely related to the S&P 500. So whatever I say on the VIX, we're going to expect the opposite to happen in the S&P. And you can see that last Friday, I said the VIX would move lower. It did that. This support level did hold. But look at the momentum indicators down here as I expand that for you. The stochastics is showing just about a cross over here, almost a buy signal with a positive divergence. So if we're seeing a positive divergence on the stochastics, when we flip to the spiders, we're most likely going to see a negative divergence there. Again, it's the opposite or inversely related to the VIX. So I believe that the VIX is going to move higher. I think we're going to test this resistance area up here from the high back on the 21st of April. Again, if we move higher in the VIX and cross over that 20-period moving average, we're most likely going to see lower prices in the S&P. So let's take a look at that. SPY is the ticker symbol. It's the S&P 500 ETF. We did move up. We didn't move all the way up to fill this gap, which is what that little hash mark is right there. Said there was a gap fill point right around the halfway point in between this range up here. But notice what's happening. Again, we came close, but not quite all the way to the target. You see the negative divergence in the stochastics right here? Let me erase these lines to clean this up for you. You see the negative divergence? We have a higher high on the spiders than we had back here on the 17th, but we have lower highs on the stochastics with a sell signal right there on stochastics and a sell signal crossing below that red line right there, which is the 100 mark on the scale. That's a sell signal as I magnify that for you. See how that crossed? And we're just about ready to cross the zero line or the momentum line. So I think the S&P 500 is going to drop next week. I even think it's going to pick up a little bit more momentum on the downside than the other markets. But keep an eye on that. Again, keep your stops in place. A good idea is possibly to trail your stop below that 20-period moving average. And as long as the stock stays below that 20-period moving average, you would most likely refrain from taking any new positions in the S&P. So that's our weekly market report. I hope you have a great weekend. Stay tuned to the market, guys, and we'll give you more next week. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.